Pricing Masters, your code to unlock the profitability and growth of your company. The best pricing and monetization strategies from Valueships experts.
Hello, my name is Kris and welcome into the Pricing Masters.
Hello, this is Maciej, and today we're going to discuss how internal data in SaaS can help you create a better pricing strategy.
So when you think of pricing strategy actually and optimizing your current pricing in SaaS, I think the first thing you actually should do, you need to do actually is to analyze your internal data. Before you go into competition, before you go into the value extraction, before you go into surveys, willingness to pay, etc., the very first step that can be very impactful for you, for me, is analyzing your internal data. Would you agree, Maciej?
Yeah, then this is even the title of this today episode, which is like digging for gold, obviously. So how to analyze the internal data for success, because I do believe that companies, they are usually sitting on a gold mine. Analyzing the data should show you like how deep your overall impact from the pricing optimization can go.
Yes, and sometimes you can actually see the first impact just below the surface, right? Because through the first analysis, you can actually see how much ROI from pricing you can get, and to actually dollarize this impact or quantify this impact. I know that you have seen the cases where only internal analysis bring 10 to 50% actually of MRR increase.
So look, let me tell you a little bit of the story on the customer that we've been working on for like a long time already. We are in the like constant relationship, but basically it was a SaaS company creating a social media related product. And what we have discovered during this stage was that some customers, and there was a certain, they had a base of the customers, like 150,000 MRR, 200, it was this size. So they're growing fast. They were already established, and they had certain costs associated with, servicing every customer, like the upkeep cost, server cost, customer support team cost, all these things. So it was about $3 for every single account that they were serving. And what we realized during this, what we'll be covering today in the episode, was like that some accounts had like minus 1700% margins because they were using so much data. They were like literally constantly asking for, customer support while paying, $1 or things like this, because they were like legacy customers, grandfather customers, AppSumo customers, stuff like this. So this is only by removing them, you had like $1,500 for free every month that you could like basically retrieve just by, killing the accounts. I'm not even saying that through like upselling them to the normal size. So this is one thing. On the other hand, you remember the one project we have done where 30% of the customers were labeled as custom. And custom, this is a hot take from this episode, it's like custom is a poor excuse for bad discounting, usually.
Exactly. So the first step actually, before going into the analysis, you need to have the data.
Correct. Yeah.
You need to gather the data. You need to store it somewhere. Preferably, you should have a data warehouse where actually you can get this information from. Of course, if you have certain scale, I'm not saying that you should start SaaS companies by building the data warehouse. This is for sure. But first thing is actually having and analyzing the data. And what would be? Can
we get a little deeper into the data? Like what type of data do you actually need? To discuss, because data warehouse seems a very, it's an abstract concept.
Broad topic. Okay, so let's deep dive into that. So I imagine you need to have an MRR data. That's for sure. What else?
Well, I would say that you can start from anything that takes care of your payments. So if you have Stripe, if you have Paddle, if you have any other like tool that is basically a payment provider, most likely they have a lot of like MRR, ARPU data already. You can use Profitwell for free. This is so you can have a very strong segmentation tool that allows you to analyze your internal data. This is a good starting point. You know, there are like chart moguls of the world, like mix panels, amplitude. They can help you with the usage data. If you don't have usage data, start gathering usage data fast. This is kind of second hot take from this episode. It's like you need to have usage data to have a full 360 like degree view on your product. But kinda these are broadly available tools on the market. Pretty much every SaaS company right now uses a different type of tool. Maybe they're using like they're something they build on their own. Maybe they're using something more established. But at the end of the day, most companies has this like basic data already, because otherwise they wouldn't be able to run the business.
So you need to have the data, and the data that like big buckets, big segments. You need to have a usage data, as you said. That would be, maybe it's not the first step, but it's important to gather the usage data. You need to have the payment data, and within the payment data, from the payment data, you should extract all the things like churn, like MRR, like upsell, ARPU, etc. So there is a certain pool of data. We can divide it into payment, into usage that should be combined, aggregated by the user ID, etc. So what would be the first thing while thinking about analyzing this data if I haven't done it so far?
MRR distribution. This is the first step I would take to analyze, and this is the first step I usually take to analyze the economics, the revenue engine of the SaaS company.
But it's not a new concept, right? I mean, SaaS, it would be MRR distribution, but going a bit broader for any company in any industries, you should actually know where your revenue is coming from, right?
Yeah, but obviously the devil is in the details, and you need to cut the data into the right pieces. This is where most companies fail. Another hot take, the third hot take. This is like 5 minutes of the episode, and we have 3 of them. But this is something that I do believe many companies are already doing, but they are not cutting the data into the right pieces. So basically, what they very often SaaS companies do is like they take the reporting from the companies that they are using to analyze data, like all these chart moguls of the world, the reporting for granted. So the way the company presents the report, it is how it is. And we only see the surface effectively. But the gold mine is actually when you dig deeper, right? So this is the whole concept. Because as you know, like the dashboards created by the companies, they are general, default, they want you to adopt in the product, stuff like this. You can even see the pipe drive reports, right? Very initially, like on the CRM, like they're very basic. Once you deep dive into them and cut them into what is important in your context, only then you start to see the details. You start to see this is the whole story.
Yeah. So let's do it. Why don't we deep dive in this episode? And of course, as a pricing consultant, people who have been in pricing for 10 years already or more, we like the concepts of waterfalls, right? So
of course, we are like ex-McKinsey consultants. Waterfalls in our brains.
Yes. So is it applicable to SaaS?
Sure.
So what would how the perfect waterfall would look like?
You tell me.
Okay, I can tell you. No, but seriously, right? I mean, thinking of SaaS, you have some revenue generated in 1 month or like in month X, right? So let it be January 2022, right? And then you need to actually understand what happened within your financial data that brought you to the December 2022, right? So you have the whole year, and what can happen? Of course, what can happen is what you exactly said. So if you had a January MRR 100, I mean, you could add some new clients, so that would be the first data. There is some upsell potential, of course, so this is what is adding to your MRR. But on the other hand side, if you have upsell, you of course have contraction. So this is the other thing within the waterfall that you should look into, and of course churn, which is actually big topic. But right now, I think upsell and contraction might be a bit more important. So knowing that,
So most companies focus on two: new MRR and churn.
exactly.
They don't really do anything with downsells, and they, for sure, very rarely do anything with upsell.
Yeah, because downsell is better than churn, right? So of course, why looking into it? Nevertheless, if you have significant downsell in your company, you still lose money. Maybe not to zero. Maybe you can still upsell this client in some time. Nevertheless, contraction is also a problem.
Watch out for the flower because it falls. Yes. It will be cut. So anyway, correct. Most companies, they basically care about, we bring the new revenue, more customer acquisition, go. This is the thing. And then we have like 5 to 7% churn. Let's do something with the churn. But the healthy SaaS companies there are like two benchmarks. So one is like the healthy SaaS company has 1/3 of their growth coming from upsells. 1/3. So if you're making like $1 million ARR, like over 300K should come from upsells.
Exactly, because for me, it's also always stunning that there is some money on the table. There are people who are already invested in your product, like your product, and now it's your job to present them the value in the way that they can use product more. So either they use more features, they use add-ons, or they grow, so they leverage the better package, stuff like that, right? And rarely this one third happens to be honest.
Yeah, and healthy like churn downsell like benchmark should be like about 15%, not higher, not less. Right? Yeah. So obviously there is a saying that the good churn is like 3 to 5%. I would say 5 is somewhat acceptable, but not. It used to be acceptable, but not anymore. I would say 3 and everything below is a good combination. So obviously the waterfall, these 4 elements, this is something like the composition of your MRR. This is where you should be looking for, right? This is where you should be looking for initially, but we're still merely scratching the surface here. Really.
Yeah. So the first step, if you're analyzing your own data, make sure to have the revenue transparency, and you can achieve the revenue transparency through the waterfall. So take the January, take the December, and see what happened in between that brought you into the December situation.
Next.
Second thing, for me, for example, what is very important is how dependent your revenue is on your biggest client.
Sure.
So this is the revenue concentration that actually will help you understand if, for example, a churn of 2, 3, 4% of your biggest clients will impact your business significantly or not. If you're selling to enterprise companies, most likely the curve will be a bit more concentrated.
20/80, yeah.
And then if you're selling to SMB, it won't be that concentrated, but still you need to, while analyzing and before doing any pricing decisions, you need to make sure how dependent you are MRR-wise,
Yes.
for your biggest customers. So the second thing, think through the concentration.
Yes, I would say that the healthy benchmark, if you're having a mix of enterprise customers or mid-market, is like 80-20, obviously. So the Pareto works
So
here.
20% of your biggest customers generate 80% of your MRR.
This is it's not necessarily saying it's healthy. I would say I said healthy, but it's a regular thing. It's something that we observe, but something that you
shouldn't be worried about that.
This is like the how life works, and that forget about the normal distribution in your life. We're living in the power law, and power law is pretty much explaining a lot of things. If you're working in the SMB, this is more 40 to 60. So 40% of our customers would make 60% of your revenue, basically. And the concentration tells you a lot. The more concentrated the curve is, it means that too many customers are paying too low prices. The more flattened your overall curve is that there is a potential for price differentiation effectively, right? That there is, so if you have like 39, 99, 149 plan, there is a potential to create plans, maybe 79 or something. Yeah, it's to differentiate with the plans to kind of to expand, and we want to concentrate it a little bit more.
But if you actually, if you are going into the segmentation of pricing, if you want to have all the analysis on your plate, beyond concentration, you also should think through the segmentation lens. Would you agree on that?
Sure, yeah, like I would say the plan distribution, this is obvious, but there's a cool hack how to present it properly. Take the monthly or quarterly and see how the movement between the plans changes.
Mm-hmm.
If the more expensive plan keeps eating the less expensive plan, it's a clear indication that customers are willing to pay more, and vice versa. If you have a certain mix changing, it means that, well, it's basically a Pac-Man thing, right? If the smaller, the cheaper plan is eating the more expensive plan, clearly the customers are willing to pay less, and they need something in between. If the expensive plan is eating the cheapest plan, basically it means that they're willing to pay more. This is a very easy rule of thumb, but it allows you to launch the right hypothesis for where to look for the growth.
And we can see, we can learn from the other, as a people working in SaaS, we can actually learn from the other industries, right? For example, so retail, the concept that you've mentioned, that one plan is hitting the other, that the other plan is cannibalization, right? So you as a SaaS company working on the SaaS pricing, you need to make sure that there is a healthy growth in the packages plans across all of them, and they also bring you the significant percentage of your revenue. And of course, if you're starting, all the tricks, pricing hacks that you have, if you anchor for the biggest plan a very high price, most likely people will choose.
Hey, don't worry. You need to have a good pricing foundation.
Yeah.
Like behavioral economics is great for conferences, and I love the books, but this is just a cherry on top. Mm-hmm. It shouldn't be your entire pricing strategy. It has to be aligned with the value, with the foundation. There is a very cool, Utpal Dolakiar has written a very great book on that. We'll link it here. But this is effectively what you need to be aware of. It's like psychology is great, but you need to have a good pricing foundation. But kind of like coming to your point on the segmentation, look, like if you have a 60%, let's assume that your overall plan distribution, you have 3 plans, and you have one plan which is 20%, the cheapest plan, mm-hmm. the other is additional 20%, and the biggest plan is 60%. What would you do with that?
I don't know.
Well, obviously there's a clear indication that you can cut it into certain pieces, because you don't want to have your entire business more than 50% of your revenue coming from one plan, because it means that you don't have any differentiation at all.
And
so
I think it's not aligned with value,
exactly,
right? Because most likely the plans that have a very low coverage are not either they are not extracting enough value, they are not providing enough value to your customers.
Right.
Or there is a pricing misalignment in the top plan, and this is super risky, right? Because it will hurt from both sides, because it means that clients from the highest plan, so the ones that are paying you the most likely either will churn because they don't see the value in the plan, the value that they are paying, or if they find your product useful, they will go into the contraction. So this is the one heart or one edge of the sword. The other edge of the sword is vice versa. The people from the middle plan, they do not have actually the expansion possibility.
Where they can go?
Where they can go, right? Even if they have the bigger wallet, even if your share of wallet in their wallet is not big, and you could actually take more money from them by extracting more value for them, they can't do it. You can't do it because you do not have a tool which would be an expansion. So we know about the MRR waterfall. We know what is the segmentation. We know what is the concentration plan distribution. Is there anything else that I can get from my
KPIs, GDR and NDR,
mm-hmm.
net dollar retention and gross dollar retention? Especially net dollar retention is critical, right? The NDR basically works in a way that if I remove any new MRR from my company, will I live in the next 12 months? Again, if you don't have upsell growth,
you will do that.
So this is very easy. Like what happens if you remove your new MRR effectively? What happens if you remove a constant stream of new companies to your business? Because this shows you how your company can grow inside the customer base that they currently have. This is like the most critical concept, and it's a KPI, but I think this is it's a popular KPI. It's a popular metric, but I would say it's still not that popular like LTV or even like CAC or whatever. But I do think that from like whole business perspective, like from the kind of bear's eye view perspective, I would say that these are the metrics that I also know the VC funds are looking for as one of the most important pricing wise. Like what is your dollar retention? Can you actually survive without bringing new business?
Mm-hmm. But all the things that we are mentioning right now, I feel like that those are, directed into the future, right? So we can analyze these things. We will know what to optimize and how to optimize it, but it will require certain effort actually to receive ROI from it. What I think is the most powerful lesson from your internal data are actually discounts.
Amen.
Bye. No, I'm just kidding. So what to do with discounts? To me, and we've mentioned that this is the topic actually of grandfathering. If you, in the lifetime of your tool, if your lifetime of a service, product, etc., if you have changed the pricing once, twice, 3 times, you need to ask yourself a question: did I actually, or have I actually increased the prices to my existing customers? If not, most likely there will be a gold mine. Second thing that you need to think about is: do I actually give discounts if the client asks to give the discount?
Of course.
And I will receive, like I would have been a millionaire if I receive a 1 penny for every time that my clients or people that are working as SaaS telling me, no, never, I'm not getting the discount.
So every time a SaaS company tells that they're not giving discounts, the pricing consultant dies.
Yes. So this is the thing. And the other layer, and I think that this is quite interesting. You can not only give the discount that is, the percentage discount or dollar discount, but the third thing is actually the feature discount, the user discount. So look through the lens of usage into your clients. Think, for example, if they have the features, if they don't have the features from the second plan while using the first plan. So thinking through the discounts, I would actually recommend those 3 analyses. So grandfathering, discounts, and feature discounts. And do you think that this is, like, I know actually, but do you think that it can give an immediate return on investment?
Yeah, I would also add this layer, and Profitwell did the amazing analysis on that, is like why you should be caring about discounts, because discounted customers tend to churn at higher rate. And there's this whole like regression they did on the data. It's like the good discount in SaaS, like the annual versus monthly discount, this is like between 15%. So if you already have like above 20% discounts, kill it. 15% is more than enough. 10 to 15 is actually the best. 12% makes wonders. Actually, if you make the volume discounts adaptive, so 8, 12, 14, 16 based on plans, this is also another layer you can do it. And the volume discounts work. You probably purchase a jar of Nutella sometime in your life. This is exactly how it works. But kind of coming to the grandfathering, I would say there is a simple analysis. You basically go on your pricing page, see what are your current plans, take your whole last MRR of your customers, and basically divide them into which customers pay above, which customers pay below, and which customers on the catalog price. And divide it into like plan A, B, C, D, whatever, how many plans you have. Basically, we're actually displaying this chart now. And basically take the delta between the difference between the customers who are paying below versus like customers who are like paying on the catalog price. Make a sum of it. Grab your head and be amazed.
Or open the champagne.
Open the champagne.
So much work.
Like you'll be amazed what is the actual value. And this is your maximum impact. And this get you like a maximum impact you can get from removing the discounts in your company. Obviously, we're coming back to the analysis we have done, to the concentration curve, the contracts you have with the customers, the relationship you have with the customers. But basically, this will tell you if I can get like 300, 400, 500K MRR from the discounts removal. And then you can decide in your pricing process, do I want to stop and I want to roll them over to actually have 100% or 90% of my customer base on catalog price? Or do I want to create a new pricing strategy
and then upsell
everyone to the mix? And this is the strategic direction the SaaS company needs to do when they're thinking of, and they're doing it for the first time, they have never increased the prices or they did grandfathering, whether I want to clean the house or I want to build a new house and then move everyone to the new house.
Yes, but the important thing in order to succeed actually in this and, to think through the mathematics here is actually you can't expect to upsell all the customers actually to your current list price or catalog price. You can try, but you need to think of churn, right? Because some customers will churn, and I think while doing this analysis, you should actually model the ROI impact.
But you have a good upper for that.
Yes. So basically, what typically I would, because of course you can see the pile of money, right? But this pile of money that is there thanks to the discounts or due to the discounts, it is there for the reason. So most likely some customers were actually looking for their discounts or influence their decision. Probably those were only 10% from what I've learned so far from my work. But in order to understand the discounts and how much money is actually there, including churn, I would recommend to do two things. So first of all, see what is the absolute price increase if you decide to move those customers to the list price. Then look through the lens of the percentage increase, right? So what is the percentage increase of price that they will be paying monthly if you actually upsell them or move them to the list price? And you will see the matrix, right? And this matrix will provide you with the segment. So customers that receive small percentage discount and small absolute discount most likely are the least likely to churn. Customers, on the other hand, who receive very high percentage discount and very high absolute discount, those are the customers that will need a special care if you don't want them to leave. Maybe some grace period, maybe some contract closures that will help them to swallow the price increase. But if you want to actually do it properly, it's not only analyzing it through the lens of discounting, but you also need to take into consideration churn, and then you need to create an actionable plan of action, but you need to create an actionable plan based on the segments that you will receive from this easy matrix. Of course, there are more complex analysis to do that, but for me, this is definitely the first step. And once you have the segment, look how much MRR sits within this segment. In a lot of MRR sit in the segment of high absolute price increase and high percentage increase, most likely there will be a challenge with price increase. Nevertheless, typically the distribution is pretty wide, right? So this is actually, this is now not about analyzing it, but how to approach it. And you can't approach it
sure. So
customers the same.
So absolute versus percentage. On the one axis is absolute in dollars, and on the other is percentage. And this is a cool thing. And also what you can add on that is the potential churn of like take your current churn, multiply it by 2, multiply it by 3, multiply it by 4, and you will see how many of your customers you keep losing. And then you can do this kind of thinking experiment of how much can I sacrifice in order to get back the MRR. We have covered it in the earlier episode, right? This company that was literally willing to sacrifice 25% of their customer base, but still receive a positive MRR uplift. And guess what? No one left. So this is exactly what is happening, because usually, while you should be prepared for a super hardcore churn is very unlikely to happen. But obviously, this is a good.
But you need to remember that you need to factor churn, right? You can't be only shower of roses. Yes, discounts. Let's price increase. Make sure to be on the safe side, especially that you already have all the data.
Basically, Kris, I think we kind of have covered, obviously, scratch the surface, because these are not like the longest episode. Probably we could make an episode of the explain the analysis one by one, which, if you like, leave us a comment, let us know if you would like to see it. But kind of to conclude today's episode, let's discuss what we have learned today. What are the key 3 main actionable insights you would say the SaaS companies who are thinking about changing their prices can do initially?
So there are 3 things for me, right? First thing is revenue transparency. Make sure where your revenue is coming from and see the benchmarks. You will know where to dig and where to optimize by receiving a revenue transparency. Secondly, not all the clients are the same and not all the plans are the same. Make sure to segment your plans versus your growth, customers growth, and versus MRR, not impact, but MRR size of each plan. Think through the concentration to make sure that you know how dependent you are on your biggest clients. Third thing, there is most likely a big pile of money in your discounts. Do this analysis and start working on increasing the prices to the customers that are paying too less versus the current list price, but make sure to factor the churn so you are on the safe side. And through this, I know from the experience that we were able actually to unlock from 10 to 30% of MRR.
Pure FYI, like from our experience, the biggest impact we are actually receiving on projects for customers, but also what our customers and people who read our content do on their own is like they are removing the discounts and doing anything with the current customer base without changing anything on the actual pricing page. So this is important. Pricing, this is important thing on my end. I would say only one, and I think we can very nicely conclude the episode because we'll be talking about pricing pages in the next episode. But pricing is not only the pricing page. Many companies associate the pricing with the pricing page, while pricing page is only your kind of front office to the customer. Everything else on the back end that is happening is also part of the pricing process. So not getting too overly focused on the pricing page is also an asset, and kind of looking at the data, because there is a goldmine. Okay.
Fully agree with you. Thank you very much for today's episode and see you soon.
And for me, there is obviously a book. Obviously, there is a book that I recommend. This is a good one. Pricing for Success, Mark Peacock. Freshly, a very new book. This has been published some months ago, 6 months ago. It's a very good one. But also on top of that, the one that we don't currently have, but if you get interested in the pricing, we have mentioned Herman Zeman in the previous episodes. Confessions of a Pricing Man. We'll be displaying it as well. Very good piece. Very short, maybe not that short, but very good one. An essence of the nuances around the pricing as a business concept. Very much recommended. Very European based also, because we mostly have European audience so far, but very European based. So also getting you a little bit of our context. Very much recommended. And on the next episode, we're actually covering the pricing pages. We're discussing about differentiation and positioning versus the competition. So thank you. Remember to subscribe to our channel and take care.
See ya.